Well, with us today is Dan Ohlweiler, and
once again,
once again, good to see you. And as I mentioned this a little bit earlier, we got a month left, and tax season isn't that too far away.
Heaven forbid.
Yes, yeah, I know.
Always some year-end tax planning strategies, but you know, it's a little bit different this year, not knowing what's going to happen with the tax bill in Congress and things like that. So
yeah, and you know, you bring up a very good point, because although it's not going to affect anything in 2017, looking ahead, people may decide, well, I might need to change things around, but we don't know yet.
That's the problem. You know, they always say, you know, defer income and accelerate deductions. You know, but that's going to be consistent with any year that you're planning. But the unfortunate thing is some of the deductions that you may be looking at may or may not be available next year. Right. You know, depending upon what happens with the tax law.
That's true.
You know.
So we're going to go over a few things here, and you sent me these pages here about tax planning tips for an uncertain environment.
Right.
But here's the first one that really pertains to our state or where you live. It's about your residency, and we certainly have a lot of people in the village here who live somewhere else during different times of the year.
They call them snowbirds or whatever they are, and you obviously, where your residency is, it will depend upon which state you're going to be taxed in. And so some people may live in Arizona during the winter time and here during the summertime or whatever, or Florida or wherever it is, Texas. And so basically you just need to kind of decide where you're spending the most time, because if you're in a state where your driver's license is, you've been there, I think the article says 183 days out of the year, that's the state that's going to be determining how you're taxed.
Right.
So if you're in California for 3/4 of the year and then decide to go to, you know, Arizona during the winter time or whatever it is, that's not going to save you any income tax, because California is going to take priority over that.
Right.
So it's just saying, you know, make sure you're calculating which state you want to be taxed under for income tax purposes.
Yeah, and it becomes, I imagine, in some cases, kind of a game that you might play, because if you do have
be surprised what I talk to people about. You know,
if you do have a residence in a state that has a lower tax level,
Texas doesn't have any state income tax.
Right.
Florida doesn't. You know, those types of things that you may want to. Nevada, another one. I have a lot of people say, well, I've got a condo in Nevada that I use for income tax purposes. Yeah. You know, and they live here. You know, but they're all, you know, they have a driver's license in Nevada, whatever it is. Everything's okay unless you get audited. Right. You know, once you get audited and they verify where you're actually living, that's going to run into problems. Yeah, and I guess they could tell by maybe your utility bills or whatever it might be. Absolutely. You know, how much utility bills you're paying here in California. Well, obviously, if you're here 3/4 of the year, the majority of your utilities is going to be in California. Yeah. So, you know, they're just saying, you know, be careful how you want to structure that, and everything's okay unless you get audited. Yeah. You know. So that's a good point. That should be that's the mantra for everything. Yeah, that should be on your license plate frame, right? That's a good one. Right. All right. Use itemized deductions before they're gone. And right now, you hear quite often on radio ads. You know, come on in and get this done. Get your dental work done. Get this done. Right. Now, of course, once the new year starts, you're still got those. Yeah, those other benefits. A lot of times you have the company benefits in your health savings accounts or whatever. Yeah. And they tell you if you don't use them, you lose them. Yeah. You know, so they're saying to come in and get all your dental work or eye work or co-pays done, so you get to use them during the year. Well, that's good and great, but you also need to determine, you know, what's going to happen next year with the tax bill. You don't know how much deductions you're going to have available in regards to itemized deductions next year. And so it probably is a good time to start looking at, and if the deductions don't go away, that's okay, but some of them are going to go away.
Yeah.
I mean, that's just going to happen.
Yeah, I think so. Estate planning and gift
well,
tax.
that's another one. The Senate proposal is they eliminate estate taxes. Which I think would be good overall. For the majority of us, 95% of us, they have a $5.4 million estate exemption right now, and so it doesn't affect any of us. Okay, most of us, I should say. Some of your viewers might be lucky and have struck it rich, but for 95% of the people in America, we have an exemption that's going to cover that. They're looking at maybe eliminating that.
Yeah.
Okay, and that may or may not affect us technically, but it's something that we can plan for.
Yeah. Now the next one may not affect a lot of people here, but some still work, and this is about making up a tax shortfall with increased withholding. Of course, with increased withholding, it also means your paycheck might be. You're almost
making money is good news, bad news. The more money you make, the more taxes you have to pay. And if this year has been a good year for you, you've had some extra commissions or something coming along, and you realize you're going to owe some taxes, you're better off, getting those taxes paid this year and getting a credit for them, either state taxes or whatever.
Yeah.
And so you don't have to run into a problem of coming up with money in April.
Yeah. Which we did last year. Wasn't a lot, but still, it still hurts. All right, here's an interesting one about leveraging state and local sales tax deduction. Now explain that.
Well, there's a standard deductions based upon your income, the size of your family that you can take, for high states with high state income tax or sales tax like California. You can get a standard deduction for sales tax based upon your income and size of your family. They should take advantage of that, and be able to say, okay, based upon our income and our family, they estimate you should pay X amount of dollars in sales tax. You can deduct that off of your taxes.
That's a standard deduction along with your other ones. Okay.
Now the real discussion in Congress right now is whether or not those income tax, state income taxes are going to be part of the tax package, which you'll be able to currently write off now, but might be eliminated as an itemized deduction in the future. So income tax and sales tax are different. The income tax is what they're looking at eliminating as a deduction on our federal tax return.
Right. Now, do you know, a quick question on that, if they eliminate the state income tax, are they talking about what you pay throughout the year or what you pay at the end of the year?
No, that's throughout the year.
Okay, throughout. Right now you can deduct
what you're
that.
Totally. We can write off, say somebody has, I don't know, $10,000 of state income tax they've paid. They get to deduct that off of their federal income tax return.
Okay.
That would eliminate, the tax bill would eliminate that, which if you're in a 25% bracket would add $2,500 to your tax bill. State income property taxes is another one that they're looking at. Okay, so those deductions are ones that may be impacted.
Is it true that you're already taking that out anyway because you're being taxed on your net income, or am I wrong?
No, you're being taxed on your gross income.
Okay.
They're just taking your deductions out of your paycheck.
Okay.
You're taxed on your gross income.
Okay. Accelerated deductions and defer income.
Well, that's the standard mantra at the end of the year.
Yeah.
We want to accelerate the deduction we have and defer income. So if we can prepay our 218 property taxes, you can actually prepay income taxes.
That's right.
Yeah. And so if we can do some of those deductions that we can deduct today, which may not be available next year.
Right.
Okay. those are some other things we obviously want to consider.
Okay, leverage retirement account tax savings.
Well, that's an interesting thing. Obviously, if we can, our retirement accounts or 401ks, you want to take advantage of those. So there's a lot of misconceptions sometimes about contributing to IRA accounts. Obviously, it has to be what is called earned income.
Right.
It can't be investment income that we've made $10,000 this year. I can convert it. A lot of questions regarding Roth contributions. You have to be under a certain income level in order to contribute to Roth. There is no limit on conversions, however.
Okay.
So you can convert $1 million from a traditional IRA into a Roth IRA. But if you're making lots of money, you can't contribute into a Roth yourself, so you can convert what you have. But there's a little end around you can do for those that making too much money, so they don't qualify for a Roth. They can actually do what is called a non-deductible traditional IRA.
Okay.
You're not going to take it off your taxes. Okay, you can't deduct that off your taxes. You can convert it or contribute to a non-deductible IRA, and then convert that to Roth.
Okay.
Because there is no restrictions on conversion.
Right. Yeah.
So there's a kind of end around you can do to get money into a Roth IRA.
Okay. Now the Roth, you pay the taxes up front, though.
You pay the taxes up front, but it accumulates for the rest of your life on a tax-free basis.
Yeah.
So it's kind of like the Fram oil filter. You can pay me now or you can pay me later, and if you pay me later, you're going to pay me more.
Yeah, definitely. So. Document key business activities.
Well, that's just if you're self-employed.
Yeah, and there are people here that are.
You document, your mileage, business expenses, those types of things. Keep a little bit. Again, those are all things that you want to be able to utilize on your tax return for income tax purposes.
Okay. Now the final one is charitable deductions. Now, you're considering them now. You're towards the end of the year. And there's so many different kinds. I mean, we've talked about you just give a lump sum. The other ones are those annuity type.
There's a lot of different things that you can contribute furniture to Goodwill and get a receipt for that.
Yes.
Okay. It's just what they call the fair market value of your contribution. Yeah. And so you can contribute clothes. It doesn't have to be monetary, but that's the most probably common type that we have. So that's the other issue that's going to be in this tax reform. Are they going to still allow deductions for charitable contributions and things along that line? But if they take that away, it's going to really put a damper on some of these charities that are dependent upon contributions to go forward.
I mean, let's face it, a lot of times people do contribute, yes, out of the goodness of their heart, but if it's major contributions, they're looking at it for different reasons. Especially corporations.
Yeah, we've got our year-end client Christmas appreciation dinner coming up next week. And we sponsor a charity. This year it's Make-A-Wish Foundation. We've done some interviews with them along the way, and we'll probably raise $10,000 to $15,000 from our clients, as well as we match contributions. So as a business deduction, we get to deduct that as a charitable contribution. So, but it's going to a good cause, and if I can get a little bit of a tax break as a result of being charitable, I'll take it. That type of thing. So, there's some things that you can do, some plannings. What's kind of put a bug in the oil this year is the tax bill. We just don't know what's going to be left on the table and others that are going to be cut out, type of thing. So, it's uncertain, but we always want to increase deductions and defer income if we have that possibility.
That's true. The good news is, which we'll talk about maybe next time, is that at least as of this moment, we got another record high for the stock market. So that part's good.
I just don't know. Don't get me started, because I don't know where that's coming from.
Yeah.
You know, we're going on 8 years now that
Yes.
the market has had a great run. And I'll take it. My clients love it, but I just don't know how it continues to go.
Yeah, I guess we'll see.
We'll have a correction one of these years, I guess, and I would have thought it would have come a couple of years ago, but you don't know.
Yes, that's true. Hey, good to see you.
Good to
Happy
see you.
holidays to you.
Same.
Hey, listen, you want to get a hold of Dan? He always talks about just come on in. You need a free consultation just to see how they may be able to help you out. And take advantage of that.
Yeah,
definitely.
we do a what we call our retirement weather report for
Yeah.
people. It's a kind of a. I know you do the forecast
Yes.
during the next week. It's a kind of retirement forecast.
Yeah.
We project out your income and expenses over the next 25, 30 years
Yeah.
to see how much income you've got or how much assets you have left over. And it's, we put a whole plan together for him.
Take advantage of it. He's a good guy. So is everyone else over there. Good to see you. Happy
Good to see
holidays
you.
to you. And we'll probably see you again before Christmas,
probably.
I think.
I think so.
All right, we'll be right back.